Have you ever noticed that the wealthy keeps getting wealthier and they do so without selling off their original asset? You might be wondering, how can you gain the same level of success? So today, we're going to show you how to do this with 3 simple words: buy, borrow, die. Sound morbid? Well, it's actually the opposite. In today's episode, we're going to explain to you what buy, borrow, die is from a strategic perspective, how it works, and how you can apply it to your situation, and then of course, how to avoid pitfalls that you might not see coming your way. Like most of us living in Southern California, maybe you're a fan of the avocado toast, or even if you live elsewhere, there's a good chance that you simply enjoy some chips and guacamole from time to time. Do you know what these 2 things have in common? Guessed it right? The avocado, specifically the Hass avocado. This fruit, yes, fruit is not only rich in nutrients, but it's actually originated from a single tree planted by a mail carrier named Rudolph Hass in La Habra Heights, California in the 1920s. He patented the tree in 1935, and since then, the Hass avocado makes up for somewhere around 80% of all avocados consumed worldwide. Much like how the Hass avocado tree essentially is a clone grafted from the original and never grown from the seed, the buy, borrow, and die strategy allows the wealthy to accumulate wealth without having to sell off the initial investment. Think of it as a legacy of the first avocado tree perpetually growing through its clones, and the value of the initial investment continuously expanding without ever needing to liquidate it. This approach ensures the original asset's value spreads and endures for generations to come. So you might be wondering, where did this crazy strategy come from, and how can I take advantage of it? Stick with us and we reveal the answers to both those things. But first, a little history lesson. You see, this strategy is actually rooted in the American tax system, and its brilliance lies in its simplicity. It's been used for over 2 decades, all thanks to Professor Ed McCaffrey, who ingeniously condensed the intricacies of the American tax system into 3 simple phrases. To put it in super simple terms, buy, borrow, die operates on a fundamental idea. When wealthy individuals purchase assets like stock or real estate, they choose to borrow against these assets rather than selling them. Ultimately, upon their passing, the estate transfers to their heirs or beneficiaries. The buy, borrow, die strategy is particularly attractive to individuals with significant wealth who wishes to preserve the assets for future generations while minimizing capital gains tax. More on that later. So listen, building generational wealth really boils down to these 3 items. Number 1, what you buy. Number 2, what you do with what you bought. Number 3, what happens to it when you die. Quite simply, the answer to these 3 points is the building block for generational wealth. Stick with us until the end and we'll show you how it fits into your overall investment strategy. But first thing first, the first thing you're going to do is you're going to buy something or invest in an asset that appreciates in value over time. In other words, invest in things that will be more likely to have more value in the future than it does today. So think about investment that have potential to appreciate over the long haul, whether it's stocks or real estate or other assets that tend to rise in value. This is your foundations, the first piece of the puzzle in the world of generational wealth and creating a lasting legacy. Let's explore these a little bit more. Stocks are a common choice for many investors. They represent ownership in a company and can appreciate in value over time. The buy, borrow, die strategy can be applied here by purchasing stocks that have strong growth potential and then borrow against them when the need for liquidity arises. This strategy can help you access funds without triggering immediate, capital gain tax, allowing your investment to continue to grow. Real estate, especially income-producing properties like rental apartments or commercial buildings, is a standout asset for the buy, borrow, and die strategy. The combinations of property appreciations and rental income makes it a perfect fit. You can purchase real estate, let its value grow over time, and borrow against its liquidity, using the borrow fund for your other investment or personal needs. When you pass away, the step-up in basis can help minimize capital gain taxes for your heirs. Art can be a valuable asset, but it may not be as liquid as stock or real estate. However, it can appreciate significantly over time. In the buy, borrow, die strategy, you could consider borrowing against your art collection if you need it. Fine wines can appreciate in value, but they may not be as widely used in the buy, borrow, die strategies as other assets due to their limited market. Now, collectibles such as rare coins, vintage cars, and antiques can be part of your wealth portfolio. Similar other assets can be deployed in the buy, borrow, die strategy by borrowing against them when needed, and your heirs can enjoy the advantages as well. I agree, Palm. You guys, our ability to accumulate over $300 million in multifamily apartment portfolio in just 5 years can be largely attributed to our dedicated emphasis on income-producing real estate that can check off the following 5 boxes. These 5 criteria, when combined, create a well-rounded investment strategy that not only generates income but also has potential to appreciate in value, offer tax benefits, and provide tangible security and guard against erosive effect of inflation. Number 1, steady cash flow is a super basic requirement for income-producing investments. Whether it's from rental income from real estate, dividend from stocks, or interest from bonds or a consistent, predictable stream of income is essential. It not only provides you with regular funds to cover expenses or reinvest, but also ensures financial stability. Number 2, appreciation potential. Appreciation potential simply means an asset's ability to increase in value over time. This is a key factor in building wealth as it allows your initial investment to grow. Number 3, tax benefits. Understanding the tax advantages associated with your investment can significantly impact your overall returns. Certain investments like real estate offer tax benefits such as deductions for mortgage interest and bonus depreciation. Number 4, tangible collateral. Investments that offer tangible collateral such as real estate provide an additional layer of security. Number 5, inflation hedge. Assets that acts as an inflation hedge are important for preserving your purchasing power over time. As you enter the borrow phase, the strategy shifts away from selling assets for cash. Instead, you use them as collateral to acquire tax-advantaged wealth. What makes this strategy particularly compelling in the context of multifamily apartments is its dual benefits. Its rental income from the residents consistently covers the loan, and the growing asset value driven by net operating income and inflation allow you to repeat the process multiple times. Let's take a look at our A-class apartment complex in Houston, Texas as an example. To understand our initial loan term, here's a breakdown. In July 2022, we purchased this property for $68 million. The primary loan on this property was secured for $45 million, resulting in a leverage ratio around 64%. The property's income consistently covers the mortgage payment. As our revenue increases and expenses decrease over time, we can expect the net cash flow to steadily rise. You might be thinking, great, but what's your exit strategy? A win-win approach for both us and our investor would involve considering a cash-out refinance in year 3 or obtaining another loan against the property. After repeating the cycle once or twice, there's a possibility that our investor could have fully recovered their initial principal while maintaining the equity stake. As a result, their investment would potentially yield infinite return. While the idea of death may sound super morbid, it's inevitable for every one of us. For those who aim to leave a substantial inheritance for their children, grandchildren, or even great-grandchildren, with the goal of establishing a lasting legacy, perhaps spanning 100 years, it's become crucial to lay out a comprehensive plan from the outset. To make a whole process smooth, think of setting up a family trust as the final piece that elegantly ties everything together. Family trusts are a crucial part of a well-planned, long-term strategy to preserve your wealth. Even if you don't think you need one, family trusts are a cornerstone of effective long-term wealth preservation. They offer a range of benefits like bypassing probate, giving control over how your assets are distributed, reducing inheritance tax, safeguarding your assets from potential creditors, and ensuring seamless management transition when you are no longer able to oversee your financial affairs. In essence, they are a powerful tool to secure your financial legacy and provide for your loved ones in a structured, tax-efficient, and protected manner. So look, we talk about all the benefits, but you have to know that like anything in life, this isn't all sunshine and roses. We have covered a few types of assets that can potentially work well for this strategy, and we have already discussed why multifamily apartments are the top choice to maximize the buy, borrow, die system. So let's dive into some crucial pitfalls to watch out for. The first is sustainable cash flow. Regardless of asset class you select, it's essential to ensure it generates net positive cash flow after covering all expenses, including the mortgage. This steady income is foundations of successful long-term strategy. Next up, if you consider using stock holdings as your collateral, it might sound appealing, but it can be super risky, especially in volatile stock market. When your stock is used as collateral, a drop in prices can force you to sell or provide additional funds to cover the losses. While it offers a way for you to have quick access to your money without selling your property or asset, it can also lead to significant losses. Last but not least, your asset stability and growth. The stability and growth potential of your chosen asset class are pivotal in making the refinancing strategy work. If the underlying asset doesn't tend to appreciate in value over time, it may not be the best candidate for this approach. Select assets that have a history of growing in value to maximize your long-term goals. Okay, so now that you have learned how to use the buy, borrow, die strategy to create a lasting legacy, watch this video to learn how to print endless money and get rich forever.